your mortgage payment. You have interest rates, APR, insurance, tax, all this stuff. What does it all mean? I'm going to answer that right now. What's happening, everybody? I'm Huddy, and in today's video, we're going to answer the question, what goes into your mortgage payment and what exactly is APR versus your interest rate? The first thing we want to talk about is the interest rate. Now, it doesn't matter what the interest rate is. Let's assume it's maybe 4%. That is your cost to 4%. That is your cost to borrow money. So we're going to take 4%, we're going to amortize it over your loan term. In most cases, it's 30 years. Really depends on your loan term, but we're taking that cost or your interest rate to borrow that money and we're going to amortize it over 30 years. The other thing that's going to be calculated into your payment in most cases is your homeowners insurance. Most lenders are going to do what's called escrow your insurance and your taxes. Your homeowners insurance is something that you are going to be required to carry by your lender. That premium, it's going to be broken down monthly. It's going to be factored into your payment because your lender is going to collect each and every month a certain dollar amount to be paid once a year to your homeowners insurance. So that's added into your payment. Let's talk about your taxes or your property taxes to be more specific. That can really depending on the city, county, or sometimes even the street that you live on. When I'm consulting with my buyers and they're looking at properties, I want them to specifically look at property taxes because that's going to be an indicator of where your payment's going to go. So property taxes. As a mortgage lender, what is going to happen is they're going to collect on a monthly basis your property taxes so that depending on the state that you live in, it's either once a year or twice a year, they're going to send property taxes into the county in which you live in so your property taxes stay current. That is factored into your payment. We've talked about your principal and interest amortized over 30 years. We've talked about your homeowner's insurance. We've talked about your taxes. Now we have to talk about mortgage insurance. The quick on mortgage insurance, it doesn't protect you as the buyer or the homeowner. It protects the lender in case you default. It's an insurance that's there for the lender, and it is factored into your payment as well. It's something the lender does collect for you. Is if you're buying a townhome or a condo, you will have what's called a Homeowners Association payment or association due, and they really can vary. Your homeowner's insurance will be a lot less. If you're buying a townhome or a condo, that homeowner's insurance, think of it as like a renter's policy. Typically around between $30 and $40, but then you have your association dues. And that is not collected by your lender. That is something you have to pay separately. So you'll want to take a look at how much that is if you're looking at a townhome or a condo. APR, it's a confusing thing and it confuses a lot of my buyers because they feel like that APR is their interest rate and they get concerned because the APR is higher than your interest rate. Well, keep in mind, your interest rate is your cost to borrow the money. The APR is your cost to do the transaction. So that's why your APR is higher. Your APR factors in all your closing costs. So your lender fees, your title fees, government fees, taxes, insurance, your escrows, and it factors that in and amortizes it over the first 12 months. That's your APR. So think of your interest rate as your cost to borrow money and your APR as the cost to do the transaction. They are separate, but that APR is not what your payment is based off of. It's your cost to do the transaction. This one, we'll see you soon.